Unserviceable debt, lockdowns in China, Russia isolated. Emerging markets have had a rough year and have underperformed broader equities. I'm here with Morningstar fund analyst Mathieu Caquineau. Mathieu, are there opportunities in all this?
Yeah, you're right to say it's been difficult for emerging market. I mean, if you look at the MSCI Emerging Market Index, it's down 22% in dollars in the last 12 months. But what's interesting, Lucas, is that value investing as a style has outperformed growth. Looking at the MSCI Emerging Market Growth, it's down almost 26%, whereas the value counterpart is down 17%. So, that style rotation actually started last year and has gained some momentum this year. So typical value segment of the market, like energy, commodities, utilities, or banks have outperformed. So in that context, it's no surprising to see that value managers have done relatively better, like Lazard Emerging Market, for instance, led by James Donald and his team. We like this fund because they have a clear relative value approach. It's a bottom-up process, and they're patient and disciplined. And sometimes in the past, that discipline has worked against them. They, for instance, stayed away from the tech giants in China in 2019 and 2020, and that was painful. But they, stuck to their gun, and that has paid off recently. And we think this fund has good long-term merits for investors.
Amid this style rotation, should we just keep our hands off growth-oriented funds?
I don't think so. Fundamentally, we know investing style work in cycle, and there is rotation typically after some market excess. So as an investor, I understand it's tempting to try to time your allocation to different style, but that's a very hard thing to do right and do consistently, because simply nobody knows when value or growth will do well and for how long. So for most investors, the best idea is to stay diversified, take your profits regularly to maintain balance in your portfolio and stick to your long-term plan.
Now, when it comes to the worst hit funds, like those exposed to growth significantly, have any sold off enough to now be attractive?
Yeah, for instance, Fidelity Emerging Markets is a good example. They took a big hit this year because they had exposure to Russia. They had little exposure to value corners of the market like energy. But we think this is a fund that remains a great long-term holding. It's run by Nick Price, has been here since 2009, enjoys Fidelity's large research teams on the ground. And he picks stocks from the firm's regional portfolio, and that has worked well over time. Another example that's been struggling this year is BlackRock Emerging Markets. This is not a pure growth fund. The manager, Gordon Fraser, is style agnostic. So he's trying to blend top-down views with bottom-up stock selection. Evidently, his views so far this year have not worked well, but over time, he's proven his skills. He has built a respectable track record since 2017. So investors shouldn't give up on that fund yet.
So there are places to make money amid the sell-off. Thank you for your insights, Mathieu. For Morningstar, I'm Lucas Strobel.